To the Financial Modeling Teacher, Portfolio Selection Techniques, Part 2 lecture series. We introduce portfolio diversification in terms of many assets. First of all, let's look at the portfolio optimization, where the following variables and constraints play an important role. RP is defined as a portfolio return, sigma P as a portfolio risk or standard deviation, WR as a weight of an asset I in the portfolio. So subject to the constraints, or constraints are WI, meaning a summation or a combination of individual portfolio weights WI that must add up to 1. So each asset should fall within the certain bounds, ensuring a diversification and risk management. So that now WI, which is individual weight, should always lie within the bound determined by the minimum weight W and the maximum weight of W. Now, this brings us to the definition of an objective function. We say maximize portfolio return, RP, subject to constraints WI, the sum of WI starting from 1 up to n, which is equal to 1, provided that WI is within the bounds of minimum W and maximum weight W. This optimization problem seeks to find optimal weights WI for each asset in the portfolio that maximizes the portfolio return RDP while adhering to the budget constraints and any specified minimum and maximum weight constraints. Solving this problem can help in constructing a well-balanced, efficient portfolio. So just to sum up, the WR represents the portfolio individual asset in the portfolio, sigma I, a measure of volatility of risk for each individual asset I. And then a correlation coefficient, rho ij, indicates the degree to which return of asset I and the return of asset j move together. A correlation of 1 means they move perfectly in sync. -1 means they move perfectly inversely, and 0 means they move independently. It should be noted that the formula accounts for both individual risks or the volatility of each asset in the pairwise covariation or covariance between each pair of assets through the correlation coefficients. Diversification benefits can be captured when assets have lower correlations or negatively correlated because it tends to reduce the overall portfolio sigma P. This formulation is fundamental in the modern portfolio theory MBT for calculating and managing the risk of diversified portfolio of multiple assets. So it adjusts the indices I and J from 1 up to n to fit a specific asset in your multi-asset portfolio. So now the notation continues as we've learned from the part 1. So consider a vector. We imagine a vector of weights W, which comprises assets WI, W2, individual weights up to, let's say, WN as a vector. So, but now we've seen that when we do a multiplication, there has to always be both a vector and a column, equal row matrix with a respective length of a corresponding matrix with a column. So that now, in order for us to effectively apply this multiplication, in the case where we want to combine a return of individual assets, but taking into account or put into effect the individual weights, it means we've got to transpose this vector so that now the return of the portfolio will then be a transpose of this vector, meaning that now it's going to be a vector that is more in a column form like that. So to be now multiplied by return of asset I. So yes, the WT in this case, that's the notation. WT means a transpose vector of weight W, or this connotation could simply be vector with a prime letter then. So the portfolio risk or standard deviation can be expressed also in a matrix form. Look at the individual matrix there, which is called a variance or covariance matrix. It's a huge matrix whose entries will always have variances along the diagonal. And this must be first multiplied by a vector of weights, but also that side multiplied by a row of the certain weights. Look what we here, in order to complete this multiplication operation, we need both a vector of weights by way of a column as well as the row to complete the whole multiplication operation. So yes, the omega, that's just a sign omega. Some notations would use a large sigma like that, in which case the sigma p becomes something like W vector transpose into that sigma into W row. So now we can set a target R, or a target expected return. We can set it as a maximum objective function, or vice versa. We can set a minimum variance as a objective function in order for us to find the solution for our optimization problem. So always subject to this constraint of making sure that the individual weights sum up to 1. So continuing and expanding the matrix form, we'll then have the return matrix as we have seen as a row of W1, W2 up to Wn, all the weights multiplying into the return vector. But now I can imagine the WT here representing the weight transpose, in a sense that we originally had a vector of weights as a column. Hence, when we transpose, we'll have them as a row like that. So followed by the expanding on the variance matrix itself by way of a W weight there and a sigma or omega there, and the next one being a weight vector itself. So now this brings us to introducing a Sharpe ratio we've already touched on earlier on in part 1. The Sharpe ratio is commonly used as a metric to evaluate the risk-adjusted return on portfolio. It's one of the performance management metrics in investment management, and it is calculated as an excess return portfolio. That is, remember we said that excess return will be the return of the market minus the risk-free rate. So in this case, it's just a RP, which is a return of the portfolio, minus risk-free all over sigma P. And the RF is for a risk-free rate. Now, having done that, we now define an efficient frontier to represent an optimal set of portfolios that offer the highest expected return for a given level of risk. You will realize that this is plotted as something. Along the axis, you will have the level of risk, which is your sigma p, and then along your y-axis is your expected return. Now imagine something like this, where you have this level of risk giving you this level of return, but that level of the same thing giving you that level of return. So something means something needs to be done here. At the next level of risk, you have that level of return, maybe moving corresponding to that level of return, but at the same time with this one. So you can see we can actually strike to maximize our return while containing the risk. So the efficient frontier makes that possible. So we might be looking at a particular point there, which is a minimum portfolio area or minimum portfolio risk or standard deviation at which the portfolio achieves higher at a lower risk. So this is a plot of the portfolio, efficient portfolio. We can see the red line there. It's our minimum variance. So after a long optimization problem, that's what we are really trying to achieve. As you can see here, at a risk sigma p of 26% volatility, we are able to at least achieve the 13% portfolio return at the minimum risk. So along the blue dotted line is the efficient portfolio, efficient frontier, so that now all the profitable combination will start from this point up. Now we go on to introduce a risk-free asset into the portfolio. For instance, you might have all different equities by way of shares, but you may want to include one bond or even a money market asset into your portfolio. So that might have an impact on changing your portfolio weights slightly. So the risk-free rate here is typically known as a R-free, and also it will have a zero volatility. So adding this asset allows the investor to achieve the portfolio that lie on a straight line between the risk-free rate and the risky portfolio. Right, remember we said our efficient frontier would be like this. So that straight line might be something like this. Basically, it might be something like this straight line that will meet this one at the tangent, so that everything below this point of, let's say, where this was maybe zero, everything lying in this thing is due to the introduction of a risk-free asset. So now this means we'll have to modify the optimization problem slightly. So remember, the return portfolio is expressed in that notation of RP is equal to a weight vector transpose dot R, or a dot product of a vector transpose and a return. So the R is the column vector of individual expected return for each asset. And then the portfolio risk sigma P is expressed in that notation. So where that omega is once again our covariance matrix. So now in this case, now to incorporate the risk-free asset, now our portfolio becomes something like this. Remember, we have this weight of assets, but we are no longer certain that all this weight is going to go to your equities. So now then it means we have the task to determining that 1 minus X weight as part of our overall portfolio mix to be apportioned to the risk-free rate. So it could be part of what we had as a budget will be apportioned to buying, let's say, a 5-year bond or investing in some money market portion, and the rest of the remaining will then go to our equity by way split into stocks according to what the final outcome of the optimization problems defines. So yes, these constraints, yes, remain similar. In other words, we want to make sure that W sum up to 1 and that any minimum or maximum weights will be within the bounds. So now, having said that, this now means that just in line with our definition, we are still talking about the Sharpe ratio as we've already defined, so that now the efficient frontier now includes a portfolio that consists of a combination of risky assets and a risk-free asset. So as we've mentioned, it will be a dark straight line originating from risk-free rate to the tangent of the efficient frontier of our risky assets. So now let's discuss one of the concepts that come along with introducing the risk-free asset, the capital market line, which illustrates how portfolio's risk and return profile can be improved by combining risky assets with risk-free assets. So the portfolios along the capital market line offer the best possible return for a given level of risk or a standard deviation. Yes, I can agree with that because we've made sure that any riskiness is absorbed by that risk-free asset. In fact, for those risk-averse investors, or maybe you want to maintain a certain level portion of our risk in the risk-free asset, so to allow maybe cash flow available, liquidity availability as we hedge and invest. So now the risk capital market line then is represented by this equation here, which is the expected return of the portfolio is equal to risk-free as an intercept, risk-free rate as an intercept. The intercept meaning that where, as you can see, the intercept will always be 0, risk-free, yes, and plus the sigma itself, which is a risk of the portfolio itself, but apportioned in terms of this expected return from the market itself by the sigma, which is the portfolio, individual market portfolio. So that now this is typically a Sharpe ratio. So in other words, we are combining the risk-free rate with the portfolio risk apportioned by the Sharpe ratio. Now, this also brings us to introducing the security market line, which represents the relationship between the expected return of a security and its beta or systematic risk in the CAPM framework. It shows the expected return for any given level of systematic risk, and this is typically the CAPM representation. Now the plot for this capital market line, as we can see, we have from 0 there up to the minimum variance. At the minimum portfolio, you see that the capital line only intersect to the very bottom of our efficient portfolio, because this is exactly where the efficient portfolio has got the minimum variance. So now, meaning that only at that point is our investment safe from high risk because of the inclusion of this portion of a risk-free asset. So now just to capture the capital asset pricing model, it means that a capital asset pricing model involves estimating the expected return of each asset based on its beta coefficient, which measures its systematic risk relative to the market. We typically estimate the CAPM equation through regression analysis, where the asset returns are regressed versus the market returns. One example is, imagine you have your FTSE JSE returns, and we want to regress, let's say, a share price of Exaro. So it means we're going to calculate the log return for Exaro share as well as the log return for FTSE JSE and do a regression analysis on both. This will result in the giving us those alpha as well as your beta coefficient, which in this case the alpha will be your intercept of that equation. So now bringing us back to ER, now the CAPM equation, which will be a risk-free plus beta I by the excess return of the market minus risk-free rate. So yes, we have seen that we regress this using the historical returns, which is just as we've discussed earlier, the log returns of that individual asset. They can be daily, monthly, or whichever choice of our J that we've defined. So finally, the regression equation that we've seen is an alpha plus beta I into Rn. Now we note we introduce the Greek letter EI, which is epsilon, to denote a standard error or just an error term, meaning this error term it's indicative of some risk that is more residual risk, or like they would call it a term idiosyncratic. So now remember, in this condition we've got both a systematic risk, which is specific to the beta, to the asset, individual asset itself, which is called a beta. And now we also have an idiosyncratic, which is a market risk, or it's just a random element or random error term, which typically is more influenced by the volatility or the shock in the market. So these coefficients now play an important role from now on, because now they also help us with something like a beta to represent the sensitivity of the market movement itself. So once we have expected return and beta coefficient for each asset, we can incorporate them into portfolio optimization problem. The objective function would now maximize the expected portfolio return based on the CAPM equation, subject to constraints such as sum of weights equal to 1 and any minimum or maximum weight constraint. And solving the optimization problem can help us obtain the optimal allocation that considers both the risk-free rate and the systematic risk for each asset relative to the market. Thank you very much for listening to this video, and we hope you enjoyed. I am the financial modeling teacher. Thank you.